Right, good afternoon, everyone. It's 5 o'clock sharp. Welcome to Silverfin's webinar. My name is Miles Brown. I'm the CEO of Silverfin Capital. Very pleased to be joined this evening by global economist and director of Landfall Strategy Group, Dr. David Skilling. Hi there,
Good
David.
evening. Hi.
Now, you're calling from the Netherlands, so quick time check.
7 a.m. in the morning, so bright and early.
Go. So you're looking very fresh for 7 a.m. So today's theme is global forces and New Zealand's investment future. We'll be unpacking the economic and geopolitical changes reshaping the investment landscape, asking what all of this means for New Zealand investors, particularly in the commercial property sector, which is the space that Silverfin plays in. But before I begin, I will introduce David. He's the founding director of Landfall Strategy Group, which is a global advisory firm based in the Netherlands, where he's calling from this morning. He's a former senior advisor to New Zealand Secretary of Foreign Affairs and Trade and founding CEO of the New Zealand Institute. David now advises investors, corporations and governments worldwide on economic change, geopolitical risk and capital markets. His insights are widely published in major newspapers including the Straits Times, the Wall Street Journal and the Times, all famous newspapers. David has a master's and PhD in public policy from Harvard University, no less, as well as a master in commerce degree in economics from the University of Auckland. Bit of admin, there'll be an opportunity to ask questions as we proceed through the discussion with David. How you do it is click on your screen, a Q&A icon appears at the bottom of your screen, type in your questions, and then sort of 5 minutes before our time is up, I'll put the questions to David. Right, without further ado. To set the scene, we're seeing significant global pressure from rising fiscal deficits, tighter monetary policy, persistent inflation, particularly in the larger economies. From your global vantage point, what are the key macroeconomic forces shaping investment conditions in countries like New Zealand?
Great. Well, thanks, Miles, and thanks everyone for giving me the opportunity to be here today. So perhaps just a few sort of background comments on the macro outlook. I mean, the global economy, over the last 5 years or so has been pretty bumpy. The pandemic, obviously, the fallout from Ukraine. But essentially, over the last several years, we've seen real variation across the world in terms of economic performance. The US has been a standout performer by a significant margin, partly propped up by fiscal stimulus. But even so, the US economy has been very dynamic, very resilient, has grown very, very strongly. Europe, including the UK, rather less so. Obviously, it was hit very hard by high energy prices and the like, high inflation coming out of the Russian invasion of Ukraine a few years back. But Europe has essentially been going sideways, and a real gap has opened up between Europe and the US. On the Asian side of the world, obviously it's a pretty high growth part of the world, but China is slowing. China has been the global growth locomotive for the last 25 years or so. But China is slowing on property, on negative demographics, on a range of other things. The Chinese economy, pre-pandemic was growing at sort of 6-7%, now 5%, and decelerating further. And the expectation is that will continue. But elsewhere across Asia, India, 6% plus, the ASEAN economy is doing well. So the point of all that is to say there is real variation across the global economy in terms of where growth is coming from. Going forward, we are going to see, though, I think, some changes to that broad outlook. We're going to see China continuing to slow, I think, although with China, you never really know, but China looks like it's going to slow. 4% growth is nothing to sneeze at, of course, and New Zealand is pretty exposed to China, but it's not the salad days of 20 years ago. Europe, on the other hand, is looking a bit better, partly because governments are throwing the kitchen sink at fiscal stimulus, more military spending, more infrastructure spending, particularly Germany, but it's a broader phenomenon. And energy prices are coming down as well. So Europe is looking more positive. In the US, there are some big question marks about, to be honest. The impact of Mr. Trump's policies are still reasonably unclear, but the the consensus is for slowing growth, off what has been a pretty high base. But the US is expected to slow. So, it's still a multi-speed economy. One of the common themes, of course, has been inflation. Inflation has been high, across certainly the advanced economy universe over the last several years, through and since the pandemic. And the New Zealand experience in terms of high inflation that's now moderated, has been, very much in line with what we have seen globally. Inflation in the main is still above target, still above, the 2 to 3% targets that most advanced economies have. But it has been trending down. Central banks, as I'm sure you know, have been cutting rates in response to a moderating inflation track. But I think going forward, there is concern that a combination of tariffs, tightness in labour markets, ongoing fiscal stimulus is going to lead to stickiness, downward stickiness in inflation, right? We're just not going to see inflation get below target in a way that central banks would like. So, at the least, that's going to moderate the pace of interest rate declines. Central banks won't have as many degrees of freedom, if you like, in terms of reducing rates. And in some countries, we might see rates having to begin to be raised over time, although that's not imminent, I don't think. But inflation, I think, the persistence of inflation is going to be one of the ongoing themes. I mean, just lastly, to close this off, and Miles, you mentioned this in your questions, one of the things that we see, across the advanced economy universe is debt, particularly government debt, private debt as well, but government debt, partly because of economic and kind of strategic pressures. Governments are spending more on military, they are spending more on the energy transition and infrastructure. Part of it's catch up because governments simply haven't been investing, from roads and rail to telecoms and the like for a long time, and now they need to as a catch up process. So, and of course, aging populations and the like. So there's a lot of pressure on the government balance sheet to spend more. At the same time, raising taxes to pay for that is tough. One, tax rates are already pretty high in many countries. There's political pressure. Governments don't get voted back in by raising taxes in general. So governments are kind of caught in a vice. Big spending and investment pressures, including capex. Difficult to raise taxes. So the path of least resistance is raising public debt. And if you look at forecasts around the world, we are seeing, a rising debt track. And as a consequence, risk premium on government borrowing is increasing. And because government debt tends to be a benchmark for private borrowing, we are going to see, I think, in the main, some upward pressure on borrowing costs. So New Zealand is pretty well placed compared to many other countries. Net debt to GDP is in the 40% range. We're talking close to 100% in the UK, the US, and elsewhere. So New Zealand is looking pretty good. But as you know, there are significant pressures on the government balance sheet in New Zealand as well to spend more. So New Zealand is not immune. So there's a lot of moving parts. I haven't even yet talked about geopolitics, which I know we will. But there's a lot of things going on around the world.
Okay. Yeah, thanks, David. I mean, that's a good kick-off to a discussion, and there's a lot to unpick in there. And I've still got a lot of questions that I wasn't planning to ask that have sort of cropped up. But so I'm going to go a little bit off piste. So dinner party conversation in New Zealand always used to be about housing prices. Now it has changed to housing prices, inflation, and interest rates. And really, interest rates are what everyone is focusing on. It's in the papers every day. I look at our local economists, and they are predicting a range from 25 basis points cuts on 20th of August and stopping there through to cuts all the way down from 3.25% to 2.5%. So obviously no one is really sure as to how this is all going to play out. But I'm interested that you, on the other hand, are talking slightly longer term in terms of actual increases. What are we looking at here? What is your time frames when you're throwing that sacrilege out that the interest rates are going to start increasing again?
Yeah, so look, I mean, it is a time horizon issue, as you suggest. So near term, the next year or two, interest rates in New Zealand will likely come off, as you said, is kind of consensus. The economy is is slowing. It needs some support from monetary policy, and there is a bit of space for the Reserve Bank to do that because inflation has been coming down and is expected to continue to come down. But the economy needs, if you like, a measure of support. So in a sense that the near-term outlook, is kind of plus minus in terms of exactly the speed of reduction. But there is going to be some, and it depends on how quickly the economy recovers, how sticky inflation is. Of course, the other thing coming in is going to be the Trump tariffs. New Zealand's got off reasonably lightly, I guess, although it's still going to come at a cost, which is an additional kind of drag or headwind to the New Zealand economy. So if you like, there are some factors that near term next year or so are going to lead to lower rates. But I think the point that I'm trying to make is, one, you've got to think about time frame. And secondly, it's important to understand that New Zealand is a price taker for many of these phenomena. The price we pay on borrowing is not just set in our domestic market, it's a global benchmark. And so it's important to understand what's happening to rates worldwide. Now, again, near term, the expectation in the US, Europe and elsewhere is for reducing rates for exactly the same reasons. Inflation is moderating, central banks have some space to move, and economies need some support. So Mr. Trump, as I'm sure you know, is busy yelling at Mr. Powell to lower rates aggressively, which obviously won't happen in the way that he would like, but the direction is down. The question is kind of how much. But if you think kind of slightly longer term, sort of 3, 5, 10 years into the future, one of the big issues is are interest rates going to start moving up on the back of higher sort of structural inflationary pressures. And there are a few things going on here. There are some idiosyncratic things. So for example, in the US, tariffs are likely to be inflationary. They haven't been yet, but there are some early signs. So in the US, there are likely to be over time inflationary pressures from tariffs, from reduced labor supply because migration is down, they're deporting lots of people, as well as a lower dollar. So there are going to be inflationary pressures in the US, which is going to, I think, over time, put pressure on the Fed to be more hawkish, if you like, on interest rates than they would otherwise like. So you've got an economy that's probably softening, but you've got some inflationary pressures that I think will accumulate, will build over coming years. And then structurally, you've just got sort of fiscal deficits that are expansionary. You've got structural labor supply pressures, so tightness in labor markets, higher wages, and like around the world, we've got a bunch of fairly high pressure economies. We've got a shrinking labor supply. And we've got geopolitical and other global frictions. So in a sense, we've got a reversal of what we've seen in the post-1990 kind of great moderation period where everything was going the right direction, growth good, inflation down, rates coming down. I think the concern is that process structurally, there are some stresses emerging, geopolitical frictions, et cetera, et cetera. So again, if your horizon is sort of 5 years plus, I think there is reason for concern that interest rates may not keep on, may not return to the pre-COVID equilibrium. We're going to see rates that are higher than where we have expected them to be over time. But the caveat on all of that is there is uncertainty around level, around timing. But at a minimum, we shouldn't just assume that rates are on track to kind of get back to where they were pre-COVID and stay there.
Okay. All right. So I'll put you on the spot, David, and I know you're not in New Zealand, so not quite as close to the numbers as you probably were in previous positions. But I've heard talk that a neutral OCR is 3%. Is what you're saying? I think what you're saying is in 3 years' time, we might expect a neutral OCR of 4%, of 5%, of 6%. Take a punt on it?
No, well, not really, but I don't think it's going to be that aggressive of a run up in terms of going to sort of 4 or 5% neutral. I mean, neutral rates, by a kind of our equilibrium concept, they move fairly kind of gradually, if you like. So, I guess the weaker formulation of what I have said is that returning to a pre-COVID set of kind of level of interest rates is unlikely.
It isn't going to be as previous.
I think there's going to be some upward pressure. Now, then there's no real consensus on this. You can argue about how fast, how far, et cetera, et cetera. But at a minimum, understanding there are some pressures that are going to move upward on rates as opposed to kind of some happy low interest rate. The other point that I would make, which is a slightly more New Zealand specific point, is that New Zealand runs a large current account deficit. So a lot of our investment in New Zealand, be it mortgages or productive investment or whatever it is financed by overseas savers, right? New Zealand as a whole doesn't save very much. And so we import capital to fund stuff. Now, and that's worked tolerably well for a while. We pay a higher cost of capital because we do import from foreigners, but it's worked reasonably well. But going forward, that global marketplace for capital is going to tighten. So I've mentioned in the context of a fiscal conversation, there are real demands on government balance sheets. Public debt is moving up. Governments are going to be competing to finance those deficits, as well as a whole range of other demands for capital. Again, sort of energy, building data centers, on and on it goes. And so the ability for New Zealand to access that limited or finite pool of capital is going to be challenged. Europe wants to keep more of its capital at home to invest. China wants to keep more of its capital at home. The US is aggressively looking for capital to build its economy and finance its deficit. So for smaller current account deficit countries like New Zealand and Australia, and bigger case for UK, we are going to have to fight harder to attract that capital. And one way in which you fight harder is you pay a higher price for that capital. So there's kind of an inflation set of drivers that are going to put some pressure on rates, but it's also just realities of an increasingly intense global competition for capital that New Zealand relies on to finance, construction, et cetera, et cetera. So there are a few things going on, but these are all medium to long-term dynamics. This is not a call for the next sort of 2-3 years.
Yeah, okay, thanks. I guess one takeout from that is we probably need to do a better job of saving and putting money into KiwiSaver, so we're not quite so reliant on the overseas markets. Okay, look, so one other point you made was on New Zealand's debt as a percentage of GDP, and the figure I've got written down here is 40%, and I know it used to be 20%, and Labor did a fantastic job of spending 20%. But National is beating them over the head with that figure. They're saying, hey, you spent too fast and too loose. We're now up at 40%, and that is unacceptable. And we've got to cut costs, and we've got to get that 40% down. But are you saying that, and then on the flip side, we don't have enough infrastructure? So everyone agrees about that. We do not have enough infrastructure. So you're saying perhaps National is being overly cautious with that 40%, and that, in your opinion, that is fairly benign, and we shouldn't be afraid of borrowing a bit more.
Well, it's tricky, and you should bear in mind that one of my previous hats as principal advisor at the New Zealand Treasury. So at the New Zealand Treasury, we don't like debt, we don't like spending, we say no to things, and we're perennially black-hatted and risk averse. Right, so the reason that New Zealand has been reasonably conservative, circa 40% of GDP net debt, is exactly because New Zealand has a history of debt getting out of control back to the 1980s. We don't want to repeat that, obviously. But we're also aware that we are a small open economy that's exposed to external shocks. It could be COVID, it could be the GFC, it could be a China shock that impacts dairy, it could be a whole raft of things. But stuff happens overseas, and because New Zealand's a small country, we're deeply exposed. And if bad stuff happens, tax revenue goes down, government spending goes up, and debt rises pretty quickly. So I remember being in and around Treasury during the GFC, going from very, very nominal levels of net debt, and suddenly we had spikes in terms of trajectory, net debt getting to 70-80% very, very quickly. So in small countries, things can unwind. So the DNA of New Zealand, which is be conservative, be prudent, I think stands you in good stead most of the time. But I would say a couple of things. One, obviously our starting position is not so good because of what we did during COVID. New Zealand was one of the biggest spenders during COVID. The IMF has a league table of how much government spent on stimulus, and New Zealand is kind of right up the top of that, actually about 20%, but over. So that kind of constrains options a bit. We do have an infrastructure deficit. I entirely agree with what you just said. But more importantly, I think the history of fiscal consolidation, so attempts to kind of get government debt down through focus on spending cuts, cost control. It's just really, really hard. We saw this after the global financial crisis when lots of governments did what in a jargon is called a kind of austerity. It's just very, very hard to do because at the same time you're cutting spending, the economy is struggling, right? Because there's just not as much government spending and investment. So the GDP part of debt to GDP struggles. So I think the real challenge for New Zealand is, I mean, clearly there's some wasteful spending, some inefficiencies, some things the government has to get right, which it's doing. So fine. But if you don't get the GDP part of the equation working as well, then debt to GDP is going to struggle to kind of keep down. And I think that's the missing part. The government haven't really cracked the code on how do you get growth going on a much stronger trajectory. If you can't get that going, all the efforts at fiscal consolidation are challenging. And I would say that for New Zealand, given again where we are, the capex part of that growth equation is pretty important. Both in a near-term sense, kind of building more stuff helps prop up the economy, keeps the construction sector in better health. But more fundamentally, you need infrastructure, be it transport, be it communications, be it energy, to kind of improve the productive potential of the New Zealand economy. So I worry that we're kind of caught in a trap, somewhat of our own making, that we're in this kind of low growth equilibrium. And you see this in the UK as well. Their debt levels are much worse than ours, 100% or so. They've got these self-imposed fiscal constraints. They've got huge kind of capital requirements, as anyone who's experienced UK infrastructure will know, but they're kind of caught in this very, very tiny space and they can't grow their economy. New Zealand's in a better place, but it's a version of the same problem. And I think the New Zealand government needs to figure out what's its risk tolerance. And I would suspect that having a slightly more relaxed approach to debt is probably the right call at the moment.
Yeah, okay. Yeah, oh, that's interesting because, basically what you're saying is the government's got one half the equation right, which is introducing a bit of austerity, but they haven't really focused enough on the fun part, which is, growing income, which is, which is better. So look, you got any ideas what we should be doing then? And I'll pass them on to Mr. Luxon next time I see him.
Yeah, well, I pass these questions on to Mr. Luxon on a fairly regular basis. He's got other priorities, it turns out. I mean, I think clearly and this is to state the very obvious. There is a need to invest more sensibly and in a more disciplined way around infrastructure. I mean, again, that's kind of transport infrastructure, it's energy infrastructure. The energy costs in New Zealand are high, and that's a real constraint on growth going forward. And there's just a huge kind of backlog of maintenance work that needs to, I mean, the Wellington water pipes are the canonical example of this. So we just haven't invested in the stuff, and we need to. And it is a drag. Housing is another drag, including on attracting people to New Zealand because our house prices are out of whack with incomes. But I think taking a slightly more expansive view on infrastructure than simply kind of at the hard stuff and figure out what's going to drive the New Zealand economy going forward. For a small economy like New Zealand, and this is the PM talked a lot about this. We have got to do a much better job of getting our firms growing into international markets. Our export share of GDP is circa 25%. That's enormously low for an economy of our size. And you can't become productive by selling into a 5 million person market. And how do you grow into international markets? You do that by being innovative and dynamic and distinctive, among other things that involves spending on research innovation. And our spending there has been very, very, very low for a very long time, which is why we struggle to get out of the commodity complex and agri. We just don't spend much compared to other countries in terms of R&D in the primary sector, let alone in the tech sector. We've got some good firms, yes, like Xero, like Rocket Lab, that's fantastic, but they're all more kind of exceptions you can point to as opposed to a systematic pipeline of firms. And so industrializing that, spending more on R&D, spending more on our universities. I know not all of this is enormously popular politically, and a lot of this is kind of longer term as opposed to near term, but really having a clear view on where growth is going to come from. And for New Zealand, that's got to be based off research, innovation, skills, and leveraging the endowment that we have. But that requires money, and the government haven't been prepared to spend money in those domains. Not just this government, governments forever haven't been prepared to do that either. I've worked with many of them for the last 30 years, haven't been prepared to do it, and we are where we are.
Yeah, okay. So infrastructure is the obvious one. I think everyone agrees on that. But R&D is where we've been too frugal, and that is, being counterproductive, and it does seem logical, and I'm not sure why the politicians don't see that's where the money needs to be spent. But anyway, I'll pass your comments on, and we'll see where we get to. Right. So moving on through the agenda here, you have touched on the tariffs. I mean, it's been amazing to watch over since Liberation Day. So US has moved towards this more protectionist trade stance, and some of the highest tariffs it looks like are going to be applied to Chinese goods. So winners and losers under this tariff structure, and really what are the direct impacts on New Zealand in terms of our trade with the US and sort of flow on effect on our trade with China.
Yeah, so I mean, tariffs are here to stay. I mean, Mr. Trump has been utterly consistent for 40 years or so that he thinks tariffs are kind of a magic weapon to achieve pretty much everything. Fiscal revenue, reindustrialize the US, correct the trade deficit, achieve other demands with China and the like. So Mr. Trump is not joking. He's not mucking around. This is not some kind of negotiating ploy. He genuinely believes in tariffs. They are here to stay. The direction, if you go back 6 months before Mr. Trump was inaugurated, the direction is not at all surprising. There were some people that said, "No, he'll never do it. It's just a joke." I never thought that. I thought that he would always do stuff. What I have been surprised by is the level. We're now back to tariff levels that we haven't seen in almost 100 years, and the speed and tone with which they have been imposed. So he is busily shredding US reputational capital. He's picking fights with India, with Switzerland. Maybe Switzerland doesn't matter so much, but India certainly does. And so this is a genuine shock to the system. As I said, these are not going to go away. We're not going to see some process where these tariffs are negotiated down to 0 or 10% over the coming period. What we have is, roughly speaking, where we will be, and if anything, there is upside risk because for Mr. Trump, no deal is ever final, right? I mean, a lot of these deals aren't deals in a conventional sense. It's kind of press releases, or social media announcements. There's no actual piece of paper that you can point to yet. And Mr. Trump, if you talk to the Canadians, they know very well that even when you think you have a deal, it turns out that you don't have a deal, right? So I think there is going to be a high level of tariffs that I think are going to be enduring, certainly for the rest of Mr. Trump's administration. And once you have tariffs in place, they are remarkably difficult to get rid of. Governments like the revenue, protected firms like being protected. It's very, very difficult to get rid of them. And indeed, Mr. Biden, after Mr. Trump's first term, didn't actually do very much by way of unwinding Mr. Trump's kind of initial tariffs, mainly against China. So we need to get used to tariffs being a consistent feature. One encouraging feature is we haven't seen much by way of retaliation, right? So this has been pretty much one-way traffic. The US imposing tariffs, but the rest of the global trading system remains reasonably intact. There's not a general move to protectionism. Most other countries are looking to sign FTAs, are looking to maintain open trade channels. So that's a good thing. And I think over time, it is going to become a world -1, right? The US will do its thing. It's the largest economy in the world, so of course that matters. But the rest of the world is still, for the most part, a believer in free trade. They want to keep trade flows open. So that's going to reduce the overall kind of global economic costs from Trump tariffs. But so you've got the tariffs themselves, which are a cost to firms, are going to lead to compressed margins for firms, as well as higher consumer prices. But you've also got just persistent, at scale uncertainty, right? It's very, very hard to plan, certainly for firms. Where do I put my supply chains? Where do I locate? How do I allocate across different markets in a way that reduces the uncertainty? I'd like to sell to the US, but gee, I just don't know if it's worth investing in the US because who knows what Mr. Trump will do next week, next month, next year. But also for consumers, if you're in a trade exposed sector, you just don't know, is my job secure, right? So it's going to be a general dampening effect. So we are into a new regime that I think is going to be costly, both for the US and for the global system. We are going to see shifts in global trading patterns over time. Firms are going to de-risk from the US because counterparty risk in the US is just higher. Over the last several years, we've seen a lot of firms de-risk from China on geopolitical risk. China's just too hard of a market to do business with. There's geopolitical risk. Let's move out of China into the US. We're going to see the same process now apply, I think, in the US. Firms are just going to avoid where they can, not to zero, but they're going to reweight. reweight the US. For New Zealand, we've got off reasonably lightly in the overall scheme of things. It's not great news, but it's not awful. There's no obvious competitive disadvantage, and Australia is perhaps a little bit better, but it's not that we are disadvantaged compared to other sellers of dairy, for example, into the US. But it is going to be a negative shock. It is going to be somewhat deflationary. Again, perversely, that probably helps the Reserve Bank lower rates in the near term. And I think there is going to be some reweighting of the US in our export profile. The US has become a much more important partner for us export-wise. Since the pandemic, it's now overtaken Australia as our number 2 export market. We've been moving into the US because it's an attractive market. That process, I think, is going to weaken or unwind. Firms are going to be looking for alternative markets. So it's a new world. It's not great for New Zealand, but it's not the end of the world. It's also worth bearing in mind that New Zealand got through the Trump 1 tariff wars without too much of a cost. This is a much bigger, more comprehensive set of tariffs. It is going to be a drag. And firms are going to have to think hard about the role of the US, but also how they deal with uncertainty and kind of being a bit more prudent perhaps than they would otherwise be.
Yeah, it's interesting times, all right. And look, the one thing I'm kind of curious about is, there's a view out there that US taxpayers are ultimately footing this bill for the tariffs. Mr. Trump clearly doesn't think they're a bad idea. As you say, I didn't actually quite appreciate that. He's been a fan of them for 40 odd years. I didn't know that. Is there some truth to the idea that the US economy and the consumer will benefit from the tariff strategy, especially considering the absence of these retaliatory tariffs? In other words, is US going to be the winner, as Donald expects?
So there are different vectors of winning. So one vector is fiscal revenue. So that's running pretty high. That's going to offset a fairly, well, obviously there's a lot of uncertainty, but it's going to offset a fairly material amount of a recent budget which just passed, various tax cuts and the like. So from a fiscal perspective, there is tax revenue coming in. The question is who that tax revenue is being paid for. Is it being paid by the foreign exporter, or is it basically a consumption tax on US consumers in drag? It'll be a bit of both. You're going to see compressed margins, so sort of foreign firms absorbing some of the tariff on their own book, not passing it through, at least in the near term. We're going to see some compressed margins by US firms who have to import at full freight from foreign firms, but kind of just absorb that cost before passing on to US consumers. And then you'll see the US price guide. You're going to see some combination of all of that. It's going to vary by sector, depending on how competitive they are, depending on sort of the ability to substitute. But I think it's naive to think that US consumers will get a free pass on this. They are simply not going to. And already we are seeing early days and firms a lot of inventory building before the tariffs hit. So it's going to be a while before we see the full impact of the tariff showing up in the inflation data. But in tariff exposed sectors, appliances, bits of clothing and the like, we're already seeing inflation begin to move up. And I think that process is going to accumulate and strengthen over the course of this year. So the US consumer will pay part of it. Tariffs are a consumption tax. It's basically what this is. It's just called a tariff, not a GST, but it's essentially that. But the US is also a competitive market, right? And people want to maintain access for US consumers. So there's going to be a portion of, I'm going to just accept a lower margin, bearing in mind that profitability rates in the US are already pretty high, right? So you're off a pretty low base. You can probably live with a slightly smaller margin than at the moment. So, but overall, is the US winning? It will win if there's a steady and growing stream of fiscal revenue. So far, that's probably a tick. If the US consumer doesn't pay very much of that, of that increased cost, I'm skeptical, to be honest. I think the US consumer at the end of the day will absorb a meaningful share of that. So that's a negative for the US. But the big thing that Mr. Trump points to is kind of an element of winning. Are firms investing in the US to get around the tariff wall? So rather than paying my 15, 20, 25%, whatever it is, tariff, I'm going to get rid of that by investing into the US, accessing the US consumer tariff free. And obviously, as part of these tariff negotiations, he's been parading around, Japan is going to pay me $500 billion. Saudi is going to put this much money into the economy. So for Mr. Trump, one of the big definitions of winning is, are firms investing in the US economy? And the honest answer to that is we don't know. It's far too early to tell. We will see some of it, and you see some responses already. But I think a lot of these public relations announcements are way exaggerated. We're not going to see nearly as much. Countries know what they need to say to kind of satisfy Mr. Trump. But I think that's going to be a key definition of winning. Will firms actually invest into the US to get around this tariff wall? So it's a hard question to answer because there are different elements of winning, if you like. The US is in a much better position than everywhere else. I mean, it is the largest, most central economy in the world. It can get away with stuff that other countries simply can't. It's got the ability to kind of clobber other countries. So, but I worry that over time, the US will become a less dynamic, more closed economy, simply because once you put a tariff wall up, economies just tend to become less dynamic and less innovative. And over time, a bit like Brexit in the UK, that's going to lead to a slightly lower trend rate of growth in a less dynamic economy in the US. So, it's very difficult to be precise on all of these things. I think for the world ex the US, pretty much nobody's a winner, right? This is just bad news for everybody, and there's just varying degrees of kind of badness.
Yeah, I mean, I think I glanced in the paper that Apple was spending $2 billion on moving a production facility back to the mainland. So, obviously it is having an effect. It's hard. I guess listening to everything that you say, I tend to think that the US is going to come out tops in the short to medium term, but maybe on the longer term it'll come back and bite them. But
just one thing to follow up on that. I think one thing that Mr. Trump underestimates, and China does this as well, probably most large countries do, is that they overestimate how central they are and they overreach as a consequence. So I think, when I was in New York last month, talking to various folk, and I don't think, even among people who aren't particularly fans of Mr. Trump, I think there is an underappreciation of how much damage Mr. Trump has done to US standing in the world. People in Europe are shocked. They are angry, both for kind of security, Ukraine, NATO reasons, but also for tariff reasons. India is in a deep state of shock. China is angry, as you might imagine. Africa is angry. Everybody doesn't like the US, both in terms of what they have done, but the way in which they have done it. I mean, Mr. Trump is not very diplomatic. He's rude, he's abrasive, he's aggressive. And that may not matter so much short term because the US is the main market in town. People want to do business with the US. But over time, you are going to see people looking for options. India is not going to say, the US is the future. The US is a part of our future, but it's not as big of a part as we thought. So I think, Mr. Trump is going to have an enduring impact. Even if Mr. Trump left office tomorrow and the tariffs went away tomorrow, people are going to look at the US in a fundamentally different way. They're not going to want to be as exposed to the US for security, for trade, for economics as they have been.
It's the good old karma argument. You just can't go around being a bully, whether it's at work or as a country, and get away with it over the long term. Sooner or later, karma will come back and get you. And I do think that is going to be the case with Mr. Trump. But bless him, he's certainly entertaining, if nothing else,
and good for business.
And good for business, yeah. Okay, so look, I had a few questions here on interest rates, but I think we've kind of covered that stuff off. So I'm going to move on and sort of stick with the geopolitical theme a little bit, but focus more on Asia Pacific and the interactions between China and the US, and perhaps the positioning for dominance in our part of the world. In light of the sort of regional instability, what should New Zealand investors be keeping an eye out for in terms of what's going on in our part of the world?
Yeah. So from a New Zealand perspective, obviously one of the big economic stories for the last 25 years or so has been China. New Zealand exports to China have gone through the roof. Dairy, other primary sector tourism, at least up until the pandemic. And like so, China has been enormously supportive of the New Zealand economy, particularly since the GFC. That helped us get out of the hole. So China has been super important, and we've been able to kind of manage the tension between being Western aligned, kind of in the Australia-US camp, with a big relationship with China, reasonably satisfactory. We've been able to kind of straddle the line, as many other countries have done as well. That has become, over the last 5-10 years, more difficult. More is being asked of us by historical allies. On things like Huawei, for example, New Zealand got them out of our 5G network, partly because of pressure from Australia and the US. So it's not plain sailing. And China has become, and continues to become more aggressive, including in the region. And this is kind of a big story, I guess, of the last couple of years or so. China is now active in the South Pacific, in the Solomons, in the Cooks, sailing down the Tasman Sea, lobbing missiles, causing planes to divert, right? So it's a lot more close to home. It's not kind of happening in the South China Sea or around Taiwan. China is now extending in a fairly aggressive way into our region. So these are issues that we can't ignore, and choices need to be made both at a government level. What's our posture? How do we align with the US, with China? That's obviously really difficult at the moment for reasons that I just mentioned, right? I mean, historically, you'd think, okay, we're going to tack more towards the US, which is what we have been doing. But actually, that's a pretty uncertain proposition now. And if you look at Japan, Taiwan, South Korea, many of whom are very reliant on the US as a security guarantor, there is deep uncertainty around how reliable that guarantee actually is. And so when you're thinking about standing up against China, hoping that the US has your back, if you're not sure the US has your back anymore, you think, well, perhaps I don't want to be as kind of as aggressive on China. And the same is true to a lesser extent for New Zealand as well. So I think, in terms of things to keep an eye on, clearly the region is full of risk. Taiwan, South China Sea, India, Pakistan. There are numerous geopolitical flashpoints across the Asia-Pacific region to which New Zealand is exposed. I'm not going to make predictions on any of those in particular, except to say, New Zealand firms need to get used to operating in an environment that is going to be more turbulent. It's going to be characterized by more shocks. We shouldn't be surprised by that. That's just the world that we inhabit. It's not stable. It is going to be bumpy and turbulent, and that's just the nature of the beast. One exception to that rule, I don't expect China to invade Taiwan, so that's not on my bingo card in terms of a near-term risk. But the general proposition is we should expect geopolitical bumpiness, tensions, frictions. During the week, the Chinese and Philippine boats collided. Stuff like that is going to happen and perhaps escalate, and we should be prepared for that. But I think that the bigger issue is one of a strategic alignment. Where does New Zealand place its bets? Because the different thing about this strategic rivalry between the US and China, or between the West and China, is that it's playing out not just in terms of militaries, but in terms of trade flows, capital flows, technology flows, and the like. So these are decisions that matter for firms and investors. You can't say, oh, it's just the government. It's not the Cold War, where the US and Russia were doing its thing and it didn't really matter for business. This does matter for business. And so it's there's real uncertainty around New Zealand's alignment, given the uncertainty that Mr. Trump injects into the system. How much can New Zealand and Australia rely on the US? Actually unclear. I also think the wild card in all of this is that although Mr. Trump has a reputation for being hawkish on China, and obviously he's imposed the tariffs on China, which are still reasonably high, and people thought that he was a hawk during Trump 1. He's appointed lots of anti-China people to senior positions in the White House. I think that's all a bit of a dodge, to be honest. I think at the end of the day, Mr. Trump is a real estate guy. He wants to do deals. And I think he wants to go down in history as kind of a Richard Nixon, someone who does a deal with China. And so I think all of this controls on chips or tariffs on China are, I think, a prelude to him trying to get a sit down with President Xi, trying to do some deal with China, trying to carve the world up. Okay, China, you can do your thing in Asia. We're going to do our thing elsewhere. And so I think that's a thing to watch for over the next couple of years, is the extent to which Mr. Trump tries to do some grand deal with China that reconfigures the Asian environment, and that leaves historical US allies, most directly Japan, South Korea, Taiwan, Australia, more exposed because they are very much under the US security guarantee. New Zealand's, I guess, one step removed from that. but don't underestimate the possibility of very significant structural geopolitical change happening in the region, on an accelerated time frame. Because Mr. Trump doesn't muck around. He likes
Yeah.
to move. He likes to move quickly.
Yeah. Oh, well, that's all interesting, and not a lot of not a lot of comfort there, David, I must admit. But one observation is Mr. Trump's only got 2 years to do his remaining damage, hasn't he? Oh, 3 years. They're four over there, are they?
They are four. So I mean,
The
historically,
3 years.
the latter 2 years, you kind of a lame duck because everyone knows you're on your way out. Although with Mr. Trump, the normal rules of politics seem to have been suspended.
Yeah.
Right. So, but you can do. I mean, he's only been in power for just over 6 months, right? And the amount that he's done in
Yeah.
6 months is
Yeah.
phenomenal. So,
It's pretty
so
phenomenal.
yes is the short answer. There is a finite life term to Mr. Trump, but I don't think I take that much comfort. I think a lot can happen within a fairly short time frame.
Still got plenty of time to buy Greenland, hasn't he?
He has.
Okay. Almost enough about Mr. Trump, but in light of those changes that are occurring in our region, isn't there a case that New Zealand could be a winner as a more attractive, stable destination for international capital? Is there a bright side in this instability for us?
Yeah, so I mean, yes, in principle. I mean, both for capital, for people, New Zealand is kind of is a safe haven. We're geographically, one step removed. Kind of rule of law, fairly stable, good business environment, et cetera, nice quality of life. So, all of those things look more attractive. And obviously, every time Mr. Trump has been elected, both in 2016 and again more recently, you see a flurry of stories about, US residents wanting to flee the US and come to New Zealand. Although when you look at the numbers, it's not actually ever very obvious how many have actually arrived in New Zealand. So there is a little bit of, if the world is going off a cliff, then New Zealand is a good place to have a bunker or a scaled down version of a bunker. So that's true to an extent. And if New Zealand plays its cards right in terms of offering a value proposition to capital, to firms, to people, rolling out a red carpet, creating a growing economy with rising incomes, those things are a real asset. But I wouldn't. It also, sometimes the way that this argument is made, it kind of presupposes that New Zealand is somehow quarantined from what's happening in the rest of the world. And for reasons I've described, actually, we're not really. I mean, our economy is exposed to global shocks, be they tariffs or wars in Asia. We're exposed to a lot of the stuff. So perhaps less directly than, I don't know, Taiwan. But it's not that we're completely removed from it. So we should be absolutely leveraging whatever assets that we have, of which being a safe haven, political stability, et cetera. Clearly, one of those are assets that do matter for capital, for people. But if you don't have a growing, vibrant economy, if you can't make money in New Zealand, if we don't offer an attractive profile or pathway for migrants, then a lot of these in principle benefits remain in principle, right? We don't actually capture the value from them. So I think that's the issue for New Zealanders. There are ways in which New Zealand can benefit from turmoil elsewhere by kind of showing that we're somewhat resilient. We're a place to kind of shelter. But you have to be quite deliberate about that. It doesn't just kind of fall into your lap. And as we going back to the start of the conversation, I worry a bit about the growth outlook for New Zealand in a structural sense. Not that I'm not so worried about recession, but I am worried that our trend rate of GDP per capita growth has been very sluggish for a very long time, and there's no obvious sign that that's improving. So you've got to get both parts right. You've both got to say, look, we're a safe haven from a troubled world, but also we've got this positive stuff to offer you. Right, it's not just a place where you build your nuclear bomb fallout shelter. Right, you've got to offer a kind of a positive part of the story as well.
Yeah, point well made. We're very much plugged into the whole global picture, and so how removed are we really? Okay, look, we're running out of time. No talk on the future or forecast is complete without touching on AI. So I'm gonna have to do it. So my apologies. AI. I heard someone say that they think it is going to be far more disruptive than the internet. Obviously, we're not seeing that just now. Um, if you put your futurist hat on, I acknowledge that real estate is bricks and mortar. So, how impacted is it going to be by AI? But have you got any thoughts on AI generally impacting on our business lives, but more particularly whether there are sectors or aspects of real estate that might benefit from it? And when I'm talking about sectors, I'm talking about sort of industrial, office, retail, hospitality, data centers, etc. Are there any that might benefit, and are there others that are going to kind of be damaged by it?
Yeah. So, I mean, I'm my base case is I'm pretty bullish on AI in terms of the economic impact of AI. I think it is going to have an impact on productivity growth, on GDP growth. It's going to disrupt labor markets, both positively and negatively. But there is a very wide range of possible outcomes, right? And we just don't know. So you mentioned this could be bigger than the internet. There are some who claim it's going to be bigger than the Industrial Revolution, which is a higher bar again. But the honest answer is we don't know. The technology is still very early stage. Real world use cases beyond using generative AI for coming up with poems and answering health queries is kind of unproven. It's very much work in progress. But I think there are plausible cases in which AI is enormously disruptive, in which it can be realistically talked about in the same breath as, yes, the internet, but plausibly also the industrial revolution. But these are decades long processes. This is not next 5 years. These are deep structural processes. Obviously we are seeing part of the economic impact seen in the eye-watering valuations of Palantir and Nvidia and Microsoft. Those companies are driving US market returns. The rest of the S&P 500 not so much, but AI exposed companies are doing well. So there's real confidence in investor land that actually AI is the real deal. At least companies that are building stuff for AI are the real deal. Although the dot-com boom says we shouldn't kind of be complacent about this. Sometimes Cisco's of the world don't pan out. But there is kind of real world investment being made. So one chart, but it kind of partly answers or gives a perspective on your question, is in the US, capex on data centers is overtaking kind of industrial real estate spending, right? So capex on to data centers to house semiconductors and the like is kind of is going for a roof. So there is real money being spent on new types of real estate in different locations, often co-located, for example, with either end users or with renewable facilities, so you can kind of tap into low-cost energy. So this is going to have an impact. We're already seeing it have an impact, on kind of industrial real estate. I think that is going to continue and broaden. The US is the epicenter of this. I think that's going to broaden out over time. But the real impact of AI is not the vertical. It's not just building data centers and the like. It's when AI goes broad. Any technology, internet's a good example, is not just the companies that kind of build the fiber cable or the like. It's the companies that use the internet, or in this case, the companies that use AI. So it's industrial companies, it's research companies, it's services companies. And so AI is, by its nature, a general purpose technology. It can be used across the economy. Barriers to entry are reasonably low. And so the bull case for AI is that this revolutionizes significant swathes of the New Zealand economy, the US economy, the European economy, by just fundamentally rewriting how business is done, by allowing you to get rid of costs, to seize new revenue opportunities as well. So in terms of impact on real estate, particularly in New Zealand and Australia, I can easily imagine significant uptick in demand for kind of AI exposed infrastructure. So data centers is the obvious example. We're going to see more of that, possibly in combination with renewable energy build out as well, because these are very energy intensive things to build, and that's going to have to be in the main renewable energy, I think. So we're going to see significant capex flowing into that type of activity. But over time, I think the big impact is going to be of AI is, do we see just higher rates of trend growth across the economy from AI in a way that's going to lead to increased demand because the economy is just doing better. In terms of particular winners and losers, look, it's very, very hard to say because we just don't know. Yeah, it's far too early to say. But I think AI, even if I don't believe all of the hype, I think significant amounts of the hype should be taken seriously, and so it shouldn't be dismissed. And I think doing a mapping of AI exposure across real estate portfolios is a super important thing to be doing. Again, it's not the next 2 or 3 years that matter. It's a 5, 10, 15-year horizon.
Yeah, okay. Thanks, David. I mean, it looks like the obvious answer is the industrial sector is going to benefit, courtesy of that's where a lot of the infrastructure is going to be housed. I would guess that as AI improves productivity, if we're talking about improved productivity, we're talking about less bums on seats, and potentially that may have an impact on the office sector. Okay, well, look, it's 5 to 6, so you've got to get on with your day. I've actually only just got one question here, so we'll finish up our formal portion, and I'll just go to the questions, and it is from anonymous attendee. So thank you, anonymous. And it is alternative energy, especially solar, is rolling out at scale in many parts of Europe. What kinds of initiatives are gaining traction in the Netherlands, which is where you are, and are there meaningful opportunities for investors to participate?
Yeah, there are. So the amount of private capital going into even in the Netherlands, which is not historically very sunny, solar has gone through the roof. Partly because of government subsidies, yes, but also private capital coming in as well. We're seeing significant private capital being deployed into the battery space because one of the issues with solar is a mismatch between demand and supply in terms of timing, sometimes geography as well. And so you're having a lot of zero price energy because you don't have a storage facility. So there's a lot of private capital coming into storage as well. So yes, there's a supportive policy and regulatory environment, but a lot of private investors just see a significant commercial opportunity here. As well. Offshore wind is improving significantly. So yes, the government are doing good and sensible, the Dutch government are doing good and sensible things on consenting, on regulation, and the like. But a lot of this is also just driven bottom up by firms seeing potential for lower priced energy from low price solar and offshore wind in the case of the Netherlands, and firms seeing rapidly reducing costs of storage. So costs of batteries are falling through the floor. So in a sense, because Europe's got a kind of a carbon price, firms are looking for ways, and energy, natural gas and the like has become very expensive. Firms are looking for lower cost energy, and they are being quite innovative around that. Governments are also trying to build out infrastructure. So in the Netherlands, they are repurposing gas lines for hydrogen. Now, hydrogen, I'm not sure is actually going to play out, but it's an example of governments are being quite innovative in terms of figuring out how do we retrofit our economy? How do we build infrastructure that's going to support this green transition in a way that's going to be relevant for firms, and also trying to provide some certainty for what is kind of long-term investment decision making. But the caveat on all that, that all sounds like a very glossy, positive story. The Netherlands is also running well behind in terms of grid. There are constraints everywhere. So in many parts of the Netherlands, waiting lists for electricity connections run into the years, literally the years, because it's just the grid has just not kept pace with the electrification of the economy. And it's a very densely populated place, lots of industrial activity. And so lots of firms, office blocks simply can't build because they can't guarantee a connection to the grid. So I think the read-through for New Zealand is don't underestimate that kind of backbone, right? If you want to electrify the economy, significant capex is required in terms of the underlying grid to make sure you can electrify. Yeah, the Dutch have been very successful in some ways, and I think continue to be, but there are some shortcomings because they just haven't kept pace. They've been surprised, I think, by the speed with which this is happening. And that's true across Europe. It's not simply the Netherlands. This electrification process is happening for commercial reasons and for policy reasons, but for commercial reasons, at speed, at scale. And it's really important for both private investors, but also for governments to make sure they are investing in a way that kind of keeps up with the pace.
Awesome. Okay. What risk, your biggest global risk that sort of keeps you awake at night, and what's the one opportunity that you think could be exploited better by New Zealanders? So a bit of a tough one, but there we go.
Yeah, like it is. I think the biggest risk sounds a bit amorphous. I worry a lot about the state of politics across the advanced economy world. So, degradation in trust, degradations in state capacity, the rise of kind of populism, which is a simple way of saying, people coming up with very simple answers for complex problems because the status quo hasn't worked. There's real dissatisfaction, across the board with the status quo. Mr. Trump is a manifestation of that kind of unease. You see this across Europe as well. And so I worry that countries are becoming ungovernable. And so over time that means less good policy, worse economic outcomes. In some cases you may have political shocks as well in terms of revolutions or quasi-revolutions in countries. So I worry a lot about that. That's kind of slightly medium term, but that's and perhaps less of a risk for New Zealand, although I never say never. On the opportunity side, I mean it's a variant of my AI answer, I suppose, which is productivity has been sluggish around the world for the last, well, basically since the 1970s. It's been going down, and the bull story is some combination of AI, broader tech, in the life sciences, automation, and the like, coupled with new business models, could lead to very rapid capital deepening, much more investment, and a renaissance in productivity. So new tech, new business models, and kind of, if you like, new glory days in terms of trend rate of growth. So rather than sort of 1 to 2% a year, getting up to 4% or so.
Okay,
that's a big opportunity.
David. Yeah, that sounds pretty good. Okay, hey, look, David, thank you very much. It's been a fascinating discussion, and you've sort of given us a really useful global perspective on the issues out there in the world today. Thanks to all of you in our Silverfin community for tuning in. We're aiming for this to be the first in a series of seminars. If you do have any questions on any subjects that David raised, you can email them through to us, and I can try and answer them, or I can pass them on to David and he can have a crack. So thanks again, David. Your time's really appreciated. Enjoy the rest of your day, and thank you again, everyone, for tuning in.
Thanks so much.